So at this point, I'm thinking, okay, there is this industry that is clearly a very attractive industry to be invested in for the long term. It's capital light, it's stable and rather easy to project out over the next 5 to 10 years. It's expected to grow as well. It's got very high margins. So from here, my goal is to understand which company in this industry has the deepest economic moat and can they actually maintain that for the foreseeable future. So the economic moat has become the gold standard for value investing. These are companies that have some durable competitive advantage and have proven to investors that they can maintain that advantage for the long term. So in this video, I want to talk about one moat stock in particular that recently hit my radar that I think is valued at a very fair price right now. So the company that I'm going to talk about is ADP. And what I want to do in this video is take you through my whole thought process of how ADP initially caught my attention and why I think their industry specifically is one that is particularly attractive to be invested in for the long term. And then also talk about what qualities ADP has specifically that makes them stand out from other companies in that same industry. So I'll start with how this company initially caught my attention. So I have a few fundamentals based screeners that I use, one of which I've just called Investing Sucks stocks. And I split this out between companies that have below and above a $5 billion market cap. And the aim of this screener is to give me a list of high return on capital businesses that are not too over leveraged. So the specific metrics that I use for this is the current ratio must be greater than 1. Operating income must be at least 5 times their annual interest expense. And these are more just credit quality checks to make sure I'm not investing in a company that's going to run into solvency issues. And then I also look at their return on invested capital over the past 3 years and make sure that it's at least 20 percentage points higher than what their cost of capital is, which I measure by using weighted average cost of capital. Because that tells me the company has the ability to consistently earn high returns on capital. And then I also filter out certain industries like biotechs and financial service companies. Biotechs, just because I avoid those altogether, and then financial services businesses because the return on capital metric doesn't really work for those types of companies. Also, if you're interested in running this list for yourself to see what companies are on it at any given time, I'll leave instructions on how to do that in the description of this video. So this screener gave me about 25 companies. And then from this list, I filtered out companies that were in cyclical industries because I wanted more stable companies or were companies that I had already previously looked into. So once I ran this screener and I filtered for those, I got a short list of 4 companies I was interested in. And it's quite the random assortment of companies, but they were Manhattan Associates, Fair Isaac Corporation or FICO, H&R Block, and Paychex. Now, the problem with the first 2 companies is that they were quite expensive. For example, with FICO, which is another company that probably has a pretty strong moat, they're up 53% year to date, and they currently trade at a PE ratio of 90. And then with Manhattan Associates, they're up 21% year to date with a PE of 75. Now, personally, I don't have a problem investing in expensive looking companies. I think as long as the growth and the quality of the business is there, then it's still worth it. But that being said, these companies did look very expensive. There's a lot of valuation risk if these companies can't meet these sky high expectations. So H&R Block was the other one, and they're up about 30% year to date. And it's actually a pretty interesting case where revenue was only growing slightly. I think it was only 4% year over year, but they were aggressively buying back shares. So EPS growth has been much higher than revenue or even net income growth for that matter. So the company initially looked pretty good, and there's actually a lot to unpack here, so I think I'm going to save H&R Block for a future video. So that left me with Paychex as the one company that I thought looked most compelling initially. Now, Paychex, for those who don't know, is a human capital management or HCM company, which basically means they help companies with HR related tasks, whether it's payroll processing, benefits administration, workforce management software, or if companies just want to outsource their entire HR function, which is called the PEO model, that's what Paychex business is. So once I decided that Paychex was the most interesting one of the bunch, I wanted to understand their competitors as well. And what I learned is that this is a surprisingly competitive market with a few emerging competitors, but also some very dominant companies that have ruled this market for a very long time. There is ADP, which is the biggest company in this space that targets all types of businesses from small businesses with 1 to 50 employees to large multinational corporations. There is Workday, which has really emerged over the past 10 years as a high growth SaaS business that targets large businesses and offers a more customized product to them. Paychex, who we already brought up, is the premier HCM provider for small and medium businesses. And then there is Paycom and Paycor, who are both relatively new companies in this space that are also gaining some market share, but still quite small overall. Next, let's go over some facts about this market so that we can understand how these companies as a group are expected to perform. So overall, the market is projected to grow at about 7.5% over the next 5 years. And this is driven by a few things. One is cloud adoption. So the shift to cloud-based HCM solutions is a major driver of market growth. Companies that have successfully transitioned to or were born in the cloud, like Workday, for example, are seeing stronger adoption rates and higher overall customer satisfaction. Number two is just the fact that labor laws are only becoming increasingly complex. And for a lot of companies, it's just simply more cost effective to outsource the HR function than keep it in house. And this is a huge advantage that the big players in this market have, just the regulatory expertise to help companies stay compliant with these increasingly complex laws. And three is just plain price increases. HCM companies usually charge customers based on the number of employees they have. So as hiring within the overall economy grows, so will their revenue. And the companies in this industry typically have pretty high returns on capital. If we look at the three most mature and consistently profitable companies, which are ADP, Paycom, and Paychex, we can see that they're consistently in the 20% plus range and usually average around 30% return on capital. They're also very asset light businesses with essentially zero debt. As we can see, most of the companies have negative net debt. ADP is the only one that does have positive net debt. And Workday has over $4 billion of negative net debt. So very little balance sheet risk overall with these companies. And they're businesses with very high margins. As we can see, Paychex EBITDA margins are in the mid 40% range now, and ADP is about 30% EBITDA margin. And the emerging players like Paycor and Workday's margins are expanding as they continue to scale up their businesses. Now, the more mature companies in this space, like Paychex and ADP, have seen their margins gradually expand over time because of economies of scale. Once you have the infrastructure set up, you can take on new clients at very little additional cost. And this is one of the key advantages of being a large established company in this specific industry. Also, once customers are brought on, it's unlikely that they'll switch because changing payroll providers is a very costly thing for a large business to do. And this also gives them some pricing power to some extent. And generally, you see companies that target small and medium sized businesses have higher margins because they can offer them a more standardized product versus large companies usually require more customization, which costs the company a bit more to provide. Now, you'd think that with all this emerging competition in this market, the big players like ADP and Paychex would be worried about losing market share. But this has been the bear thesis in them for over a decade now. And despite that, they have maintained their client retention rates. And in the case of ADP, they've even increased their client retention rates over the past 10 years, which I think is one of the many data points you can point to that show that there is actually some moat to these businesses because even as competition from companies like Workday and Paycom has emerged, they're still hitting record high client retention rates. So at this point, I'm thinking, okay, there is this industry that is clearly a very attractive industry to be invested in for the long term. It's capital light, it's stable, and rather easy to project out over the next 5 to 10 years. It's expected to grow as well. It's got very high margins. So from here, my goal is to understand which company in this industry has the deepest economic moat and can they actually maintain that for the foreseeable future? And then once that's been figured out, is the current price actually reasonable? Is it a fair price? Because as we all know, if you invest in a company when it's too expensive, it's pretty difficult to earn decent returns. Now, with the high growth emerging companies in this space, so basically all the companies except ADP and Paychex, I decided to rule those ones out because after reading about their businesses for a bit and looking at the recent developments in their businesses, I realized it was going to be extremely difficult to project what their next 5 to 10 years is going to look like, much harder than it would be for ADP and Paychex. Because they're just simply less established companies that have more growth dependent valuations. And the problem with growth dependent valuations is if you incorrectly assess what their growth is going to be, you can see some pretty sharp losses for being wrong on that. And these are losses that you may never actually recover from. And the number one rule in investing is don't lose money. And the number two rule is don't forget rule number one. So this is a pretty big risk that doesn't exist to the same extent in the larger companies like ADP and Paychex. So it's not that companies like Workday, Paycom, and Paycor are definitively going to be worse investments. In fact, chances are at least one of them will end up being a better investment, but it's extremely difficult to predict which company that would be and why it would be that specific company. And just to give you a quick example of what I'm talking about here, Paycom, which is one of the emerging companies in this industry, has recently performed very badly, mainly because they introduced a new product to their customers that accidentally cannibalized sales from their other products, which led to a drag on revenue. So these kinds of things can happen with these companies that are still in the growth phase. They're introducing new products. They're trying to innovate, right? So like anything in investing, it's a decision of risk versus reward. And to me, it seems the potential reward of investing in these smaller companies isn't really justified given how strong the larger established companies appear to be. Okay, so the last step of this whole research project here was to do some rough valuations of ADP and Paychex to determine which one presents better value to investors right now. So for starters, I looked at the valuation multiples, specifically focusing on enterprise value to EBITDA, and I was surprised to see that historically ADP has had the higher multiple, but now they're currently at similar levels with Paychex, and Paychex is even a bit higher right now. Now, normally you see companies with larger moats have higher valuation multiples, and to me, I thought it was pretty clear that ADP had the larger moat of the two. They have the stronger brand reputation, being the largest HCM provider in the world. They can take better advantage of economies of scale. They have international operations, which is beneficial for companies that need to deal with many different regulatory requirements. So they're usually the go-to solution for big companies, but they also operate across the entire spectrum of small and medium-sized businesses as well. So for ADP, if we assume 6% revenue growth over the next 5 years, which is actually lower than what the forecasted market growth rate was that I showed earlier of 7.5%, we assume they get a 34% EBITDA margin in 5 years' time and a enterprise value to EBITDA multiple of 22.5, and they also buy back about 1% of their shares outstanding per year, all of which are very reasonable assumptions. We'd probably get around 15% annual returns, which I think is quite good for a base case scenario with a very stable and very mature company. Now, the bear case I would think would be 5% revenue growth, a 32% EBITDA margin, and a 20x multiple, which would still give us 10% annual returns. Now, for Paychex, if we also assume 6% annual revenue growth, a higher EBITDA margin at 48%, the exact same valuation multiple of 22.5, and then no change in shares outstanding because Paychex has historically been more of a dividend stock versus ADP, which prefers to do buybacks. Then we get a slightly worse return of 13%. And by the way, if you want to access this file that I'm showing on screen here, feel free to join my Discord server where I've posted it. The link to that is in the description. But all in all, ADP seems to be the better long-term investment in my personal opinion. Because they are larger, they can take better advantage of economies of scale going forward. They are a very shareholder-friendly company doing both buybacks and dividends, which is where almost all of their cash flow from operations goes. And despite the fact that I think they have the deeper moat of the two companies, they're still valued at a slightly cheaper multiple right now. So that's it for this video. Thank you so much for watching. I hope you did find it useful. Let me know what you think in the comment section, and I'll see you guys in the next video.